Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of October 5th. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and pleased to be joined here once again today by Steve Cucchiaro, President and Chief Investment Officer of 3Edge Asset Management. This week, along with a brief review of the capital markets, Steve and I will be taking another look at a recent shift in policy by the Federal Reserve, which has now stated explicitly their intention to allow the rate of inflation to run above their 2% target. And this is an important policy shift by the Fed, which could have profound implications, and we believe the potential impact from this change in policy may currently be underestimated by investors. But before we get to that, we'll take a brief look at the global capital markets this week. And global stocks had a very strong week of performance, as now investors are betting that lawmakers are moving closer to an agreement to provide additional fiscal stimulus to the American economy. There's also some increased speculation now among market participants that Democrats could potentially win not only the presidency, but also the Senate in the upcoming election, which would raise the chances for additional government spending. However, as we know, nothing is certain in terms of an upcoming election, and so caution and vigilance is advisable at this point. So now let's turn to today's special topic. Let's bring Steve into the conversation. So Steve, as I mentioned in the introduction, today you're going to be taking a look at this recent shift in Fed policy, whereby now the Fed intends to allow the rate of inflation to run above their stated 2% target, even if the economy is seen to be running at or near full employment. And so this change in policy removes sort of a long-standing discipline, right, by the Fed, where they react to very low levels of unemployment or high levels of employment, and they preemptively begin to raise rates oftentimes in order to avoid the onset of inflation. And in the current environment, where the Fed, has been frustrated by the lack of inflation, even in a U.S. economy that had reached low levels of unemployment, this seems to make sense. However, perhaps the shift in policy could have effects that are underappreciated by market participants. So what are the potential implications of this change in policy for the markets, and why aren't investors paying attention?
So Fritz, I think you're absolutely right that this is a radical change from past practice. And it has implications for the market cycle and for investment strategy. It's not widely recognized. It's seldom discussed in the financial press what the longer term implications like this are. Now, we know, like all behavior found in nature, markets themselves also move in cycles. And since World War II, markets have moved in what we like to call the boom-bust cycle. We have a chart that shows how this cycle works over time. I'll use an example. From the mid to late 70s to the early 1980s, we had an economy that was coming out of recession. And if we put ourselves on that cycle, think of it as on the southwest or the lower left part of that cycle. There's an economic recovery. We're coming out of a recession. And the economy's starting to do better, the market's doing better, and inflation started to take hold. And inflation started to run away because the Fed was slow to raise rates. But then they realized that they didn't want inflation to get any worse, so they started to hike rates. But as they did that, inflation kept running away from them, and they struggled to keep up with inflation. We had an overheated economy. Equities still did well for a while, but then it started to come under the strain of the higher rates. Bonds started to do very badly because of the higher rates, but gold started to soar in value. As the Fed tried to stop inflation, they kept raising rates more and more. And finally, that monetary tightening killed the stock market. Bonds are still doing badly. Gold's been doing great. And inflation is still not slain at this point. It wasn't until 1981, with even more rate hikes, that finally the Fed was able to break the back of inflation. And then all the asset classes like gold, equities, and bonds all did poorly, but cash was king. And back then you could earn 15% on cash. But then with all that tightening, we had an economic downturn. And then that was the very beginning of the 40-year bull market in bonds that we are seeing today in maybe the final stage. So that was the boom bust cycle. The Fed broke that cycle in 2020, and they've made several announcements that they plan for the next several years to not follow that cycle where they will preemptively raise rates to try to stop inflation. Mm-hmm. So I'd like to show what we are now in, which is not a boom bust cycle, but we are now in a bust reflation cycle. And frankly, we haven't seen this cycle since before World War II. Now, our primary example was back in the 1930s. We had the stock market crash in 1929. Think of ourselves in the west part of this cycle, in the left part. Equities have been doing very well. We had the stock market crash. Equities came down. The economy starts to slow down. Then we instituted trade wars several months after the stock market fell. And that just, while it was done with good intentions, it just slowed global growth and global trade all around the world. There was reciprocal tit for tat and ended up benefiting nobody. And while bonds did well initially, as interest rates came down, equities continued to get hurt. And then with the stock market falling so much, there was a panic, there was a flight to safety, and cash was king. And the markets continued to decline until the early 1930s. And then in 1934, there was a massive monetary stimulus. It was actually a currency devaluation. What the government did was they changed the fixed price of gold from $20.67 to $35, a huge change in the price of gold. But think of it the other way. It's a huge devaluation in the value of the dollar relative to gold. And that reflated the economy. Gold took off in value. Equities started to then rebound strongly. And the economy started to stabilize and recover. And this continued until the government thought we were out of the woods. And then in March of 1937, they began to raise taxes. And the cycle started again with another slowdown. The equities fell, et cetera. So that was the bust reflation cycle back before World War II. And now we're seeing it again in 2020. So if I were to take the same bust reflation cycle, we could say that equities were doing perfectly fine until February, when they peaked and then they plummeted in a rapid rate. The economy turned down. Bonds had a very good month going from February into later in March. And then there was a panic because the downturn was so sharp to worry about liquidity. And even bonds, in addition to equities and gold, were being sold off, and everyone was rushing to a flight to safety. Remember all the raising of cash, all the selling at the end of March. And then the cavalry came in, the Fed came in. There was a massive monetary stimulus in an unprecedented way. We reflated the market. Bonds really didn't move much after that. All the gain in bonds happened earlier on. Wasn't a great time to be in cash with interest rates down to zero and the Fed printing money, but gold soared. And then the reflation continued, and then equities also rebounded strongly. So we've already seen this cycle once in 2020. And the Fed is committed to implicitly maintaining the cycle because they are committed not to raise rates.
Right. Yeah, exactly right. Wow. That's very, very interesting. It's amazing you have to go back to pre-World War II to see, to find a similar episode as that. But I have a question for you, and it's about the topic that I find actually particularly interesting. And so my question is this. So clearly the Fed wants to create more inflation in the economy. Or stated another way, they desperately want to avoid, that black hole of a deflationary spiral. However, even though they want to allow inflation to run above their target of 2%, and that could boost the inflation rate, it also, doesn't it run the risk of creating stagflation, where you have a situation where you're experiencing increase in inflation, but your economy is not growing. And so you're getting economic stagnation plus inflation simultaneously, which is not a good place to be. Can you talk about that a little?
Yeah, this is a risk, and it's a risk, again, that I think is being under-anticipated by the financial media and by investors. It's not destiny, but it could happen, and it's something that we're watching. So it's no surprise, and the Fed's been as overt as they can be in declaring that they want to create inflation. And it reminds me so much of 1981 when the Fed was very clear they want to stop inflation once and for all. People doubted the Fed could do it because they kept raising rates and nothing would happen. But finally, they broke the back of inflation. People doubt the Fed can create inflation now, but they're trying harder and harder. And with the help of fiscal policy, I think they'll eventually succeed. So the question is, will this lead to a healthy growth or will this lead to stagflation? Well, to help answer that question, we have to look at what are the primary paths to inflation. There are two primary paths. One is from an overheated economy, an economy that's running too hot, wages go up in escalating fashion, demand for products and services go up faster than they can be provided. And that's what you usually see, as we saw earlier in the boom bust scenario. That's not what's happening here. That's not the likely path to inflation. When people realize that that might not happen, they say, well, there's no chance for inflation, but that's just one of the primary paths. There is another primary path to inflation. It's usually seen in countries that become overly indebted. That's typically been in emerging markets, but now the developed economies are becoming overly indebted themselves. So the second path to inflation is through currency devaluation. And as we saw earlier in the bust reflation cycle, that is when the Fed starts to print money and intentionally tries to devalue the currency as a way to reflate the economy. And if you think about it, when the Fed just prints money out of thin air, it's not creating any wealth at all. It's just creating more money, hoping that that money gets used productively in the economy. But the only thing you can guarantee is that more money is being created. And the definition of inflation is the purchasing power of your money or of that currency. So if you're creating more currency, then by definition, each unit of currency is not worth as much as it was before you printed the extra money. So how can we get to stagflation? Well, we have the combination of the potential money printing and currency devaluation. If there's more fiscal spending, I think the Fed will have to do more money printing to support it. But at the same time, we have record levels of debt in proportion to the size of the economy. And history shows that whenever a country has record levels of debt in proportion to the size of the economy, it's much harder to continue its growth rate. Growth is usually slower. It's dragged down because all that debt is really borrowing from the future to spend in the present. You have less money in the future for the future growth. So if we do get a combination of low growth and inflation, that is stagflation. Now, the kind of investments that would do well under a stagflationary environment are gold, real assets like certain commodities, TIPS, Treasury Inflation Protected Securities, because the principal value increases at the rate of inflation, and equities that are tied more to the inflationary cycle. What would do poorly in a stagflationary environment would be bonds, bond-like equities, bonds that have high dividend yields, but that those dividend yields won't be worth as much as yields go up. And then growth stocks, which have benefited greatly from low inflation, and because that contributes to the low cost of capital. So that's where we're at. It's not destiny, but it's a risk that we're watching very closely. And if it does happen, we do have access in our portfolios to asset classes that could keep making money when others might not.
Right. Very important. Well, Steve, I think you've really done some original thinking here. I think it's been a very interesting discussion, and I think that the discussion, will continue. So thank you very much for those insights. It was really helpful. So that will do it for us. Steve and I will be back again next week with another edition of our 3Edge Week in Review. And next week, actually, Steve and I will be focusing on the upcoming presidential election, as well as the congressional races and everything around the very important date of November 3rd. We'll talk about different scenarios and what these different scenarios could mean for the capital market. So you don't want to miss that 3Edge Week in Review election edition next week. All of these videos, as we have always said, are available on our 3Edge YouTube channel. And if you subscribe to the channel, you will receive notification as we release videos in the future. Always feel free to share the videos with anyone who you think might be interested. And if you'd like to submit any questions or thoughts for future topics, you can send those ideas along to us at an email address that is weekinreview@3edgeam.com. and then we will get those. And we've already had some that we have turned into topics during these videos. So, Steve, thank you again for your insights during this very exceptional period that we're in.
Well, thank you very much, Fritz, and I appreciate the nice feedback we're getting from our clients.
Absolutely. So on behalf of everyone at 3Edge Asset Management, we urge everyone to remain safe and healthy, keep the faith, and thank you very much for listening.